So good morning, everybody, and welcome to this month's IFRS and Corporate Reporting webinar. Now, this month we're looking at our accounting standards update, getting ready for 31 December 2022 reporting. And as I say that, and I look at the date, the 23rd of November, I actually cannot believe it. But this year, Kevin, I'm going on an early annual leave, so I'm finishing up in the office on the 9th of December, and then I'm going overseas, first time in many, many years. So for me, there's really just 2.5 weeks left of the work year. Maybe that's why I'm getting a panic attack looking at these dates. Anyway, to everybody, welcome to our webinar. As always, I've got Kevin Frohbus, our IFRS and Corporate Reporting partner based in Sydney, with me. So hello, Kevin.
Hello, Aletta, and hello to all our listeners. It's good to be back.
Kevin, you don't sound as stressed as I am, so maybe you taking your annual leave a bit later.
No, pretty much the same time as you, Aletta. I'm just maybe starting to bed it in.
That's really good. But I do hope that all our attendees have some holiday plans. We've been doing it tough over the last few years with the pandemic. And this year after the pandemic hasn't been as easy as I think we've all expected. A lot of staff shortages, a lot of new things. So it's been quite hectic. Anyway, to today. First of all, at BDO Australia, we have prepared our inaugural sustainability report. And we've issued it on the 31st of October, about 3 weeks ago, together with our transparency report. Now, this sustainability report for BDO in Australia has been a significant milestone. It's the first time we've prepared it, and it's just illustrating our commitment to sustainability and ESG matters. So we're not just talking about it, we've actually done it ourselves, we've walked it as well. So incredibly proud of this report. Ashley Bleeker and I, who've been running all these sustainability webinars every month, have worked on this report and together with a lot of people at BDO that provided input and data, etc. I think the whole reason for this report is the fact that we are so committed to sustainability, and we know that we've got a role to play to protect our resources for future generations, to protect the planet for future generations. But I think the other thing is we're also committed we know as businesses, for-profit businesses, we want to make money, but we do not want to make money at the expense of people. So it's about preserving the planet and looking after our people, which is incredibly important. This is a snapshot overview of our sustainability report. We've used the World Economic Forum framework, and according to that framework, there's 4 key pillars. And if you look at the middle of this diagram, it's about people, it's about the planet, it's about prosperity and principles of governance. Now at BDO, because we're a people business, we are people helping people, our clients. The focus in our report, and we've started with people, but we've also made commitments around net zero. So we've got disclosures around planet and prosperity, the number of people we employ, the number of new partners, the number of new directors, and very importantly, also the pro bono hours that we've worked with clients, with not-for-profits. Principles of governance, we've indicated there that at the moment we've got 12.5% female board members. I know we've got a board meeting next week, Kevin, and we're hoping to have more female board members very soon. Then we've got cyber security training and also our transparency report, where we're really proud of the work that our audit partners and staff have done, and we share all of that. Obviously people, as I said, people very important, and so we've publicly disclosed our number of female staff, female partners, our Net Promoter Score as a firm, our people engagement score, training of mental health and first aid officers, our training, the investment we make into our people around training and their skills and skills for the future, etc. So this is a good snapshot of the key pillars and how we respond to those key pillars at BDO. Over the next few slides, I've given you a bit of an extract. This is a document that's, I think, 76 pages long, where we tell our BDO story. You know, we start with our why, people helping people to achieve their dreams, and we work through our values, and then we look at our brand, and we look at a real story. So if you look at people, you know, we've said people who choose to work with BDO quickly discover why we're different from the rest. We're all about our people. So we've included stories, we've included information around employee engagement. What do our employees tell us about BDO? We have information around diversity, equity, inclusion. That's not just about gender. We talk about human rights. We talk about flexible working at BDO, health and well-being, and skills for the future training. And then our clients, we have information here on what our clients have told us. What do we do well? What do we don't do that well and we should improve on? And we talk about education, how we try and help clients through education initiatives. If you look at the planet section, we talk about climate change and our commitment to net zero by 2050 or earlier. We're currently busy with calculation of our carbon footprint, which should be done by the end of the year. And then what do we do to get to net zero, and how fast can we get there? That's realistic, where we've got plans in place. We talk about our facilities and how we consider new facilities and how they play into the sustainability mantra. We look at data around electricity usage, and then also waste and impact management, how we've reduced the use of paper, what we do with old laptops and phones, and how we get rid of them, recycle, etc. So it's all about the planet. In prosperity, we talk about employment and wealth generation. We talk about community engagement. So we know that we're part of a broader community where all our offices are a broader community in Australia, and the role we play in that community and the way we try and make a difference. We talk about innovation critical to businesses, and I think that's where Australia in general can play a big role on how we achieve our sustainability targets through innovation. And then finally, BDO Connect. So that's how we connect with our clients, how we connect with other professional services firms, and also linking to skills development and training. And then finally, we've included a large section on principles of governance, where we look at the governance structure of BDO in Australia. We look at board diversity and independence. We talk about business ethics and legal and regulatory compliance. And by the way, before we prepared this report, we reached out to our clients and our staff and our partners and did a materiality assessment or stakeholder engagement. And the number one item that came back, this is where all our stakeholders believe BDO should make a difference, and this is very important for everybody, is business ethics. So that rated number one. By the way, included in our report, we provide the feedback on what our stakeholders told us around what we should focus on and what we should care about and what they care about and what we should report on. And then we also have a section on risk management. How do we do risk management and oversight? So our report, incredibly proud of this report. It's a baseline report, and although we are proud of our story to date, this is now informing our business on the strategies we need in future, and to implement new strategies, policies, procedures, capture data, And then next year we'll have another report, and that report will again inform our strategy going forward, because we know sustainability is all about continuous development, continuous improvement. So if you want to read our full report, it is available on our website. I've put a link there. It's a nice visual report. I'm a visual person and I love color, so for me it was very important that we tell the story not just in words, for those who like words, but we also tell the story through diagrams and pictures, and pictures and photos of our firm and our people. All right, so that's a bit of an introduction about BDO. You know, we've been talking about this a lot. I think it's important to share that we're not just talking about it, we've done it ourselves. So if we look at today's agenda, surprise, surprise, number one on the agenda for 31 December reporting is actually sustainability-related disclosures. For example, the TCFD disclosures and sustainability-related disclosures in financial statements. It's not just sustainability disclosures in sustainability reports, which is often a separate report to the financial statements. This is actually what sustainability-related information should be disclosed in our financial statements or in our broader financial report. We know that ASIC is recommending the TCFD disclosures, APRA is recommending it, the AASB is recommending it. So we want to start there. It's a new area and it's genuinely really hot and important. Then we're recapping on some other topics, transitioning from special purpose to general purpose, AASB 1060 simplified disclosures. We're looking at standards applicable for the first time at 31 December for the annual and half year. We look at standards issued but not yet effective. We highlight IAS 1 changes, and we'll do a separate webinar early in the new year to explore that in greater detail. An update around the Ukraine-Russia conflict and how it might impact financials. We also look at listed entities, IFRIC agenda decisions, and ASIC update, Australian developments, New Zealand developments, because there's a little bit of an overlap with Australian entities, and if you've got subsidiaries of New Zealand or if you're a subsidiary of a New Zealand parent. We've got hyperinflationary economies, and there's a little bit of a change there. And then also, what's the impact of the recent interest rate increases? So what's the impact of these increases on financial statements? So it's a very heavy agenda, as we normally do. As you know, it is a high-level flyover. We don't look at anything in great detail, but we give you links to newsletter articles. We give you links to our website to read more. So if any of these topics are hitting a nerve, you can find out more information, or you can reach out to us, of course. So it will be fast, but it's just to high level. These are the things to think about. Some of the slides we will really fly across because they're more there for context. We've discussed them earlier. And another reminder is this particular webinar in November, similar to the one in May, because it's an accounting standards update, has been scheduled for 90 minutes and not the normal 60 minutes, which we usually do for our webinars. The other thing is we've not included not-for-profit specific information here. We've scheduled a not-for-profit webinar for next week on the 30th of November. It's an hour-and-a-half webinar. I'll be joined by Anthony White, our national not-for-profit leader, as well as a number of panel members. So we've got an audit partner, Elizabeth Blunt from Melbourne, joining us, and also some tax people, you know, and Fahim from a data analytics perspective. So if you're a not-for-profit entity, please register for that webinar. So if we start sustainability-related disclosures in financial statements, we've previously talked about it, that sustainability is not just emissions reduction or carbon footprint or climate change or net zero, which is the first item under environment. There's a lot of other aspects. If you look at BDO Australia's sustainability report, you'll see, because we're a people business, there's a lot of disclosures around the social area. We also have planet, environmental aspects, and obviously governance. So sustainability is not just climate, and therefore if we talk about sustainability-related risks and opportunities that are required to be disclosed in financial statements or in our operating and financial review, it covers all of this, right? It's not limited to climate. Why would you consider sustainability? I think the key thing here is that if entities want to ensure continued access to capital and continued access to markets and customers and continued access to people that work in your business, you have to address sustainability. And you know, it's just not something we can ignore. There's pressure from capital, markets, and people. And therefore, it's very important to acknowledge that stakeholders, and there's a lot of stakeholders, more than just shareholders, that stakeholders want more information before they engage or continue to engage with an organisation. Now, there are other drivers as well. We know there are some legislative requirements starting to appear. So there's a climate change bill. We know there's market demand around customers. You know, before they buy products, they want to make sure they're sustainable. We know suppliers are setting net zero targets across the supply chain. We know there's a push for disclosures. The IFRS have disclosures, IFRS standards have disclosures around significant judgments and accounting estimates. And the Task Force for Climate-Related Financial Disclosures, TCFD, recommended by our regulators in Australia, and at the moment it's recommended. However, the ISSB, which incorporates the TCFD, so the International Sustainability Standards Board, have issued 2 exposure drafts this year, IFRS S1 and S2. And I can't help, you know, when my children were young, they looked at bananas in pajamas, B1 and B2. So S1 and S2 remind me a little bit of that every time I want to giggle. But if you look at IFRS S1 and S2, they've issued the exposure drafts. They've received more than 1,500 comment letters on those, which even beats the number of comment letters the IASB previously received on the controversial IFRS 16, which I love. So they're working through these comment letters, but we're expecting them to issue the final IFRS S1 and S2 in the first quarter of 2023. And then there will be a consideration of adopting that in Australia, obviously similar to as the other IFRSs, and one would expect some kind of mandatory implementation date. So I think legislative or mandatory requirements are a lot closer than we think, and we know the regulators are pushing it, and we know they're asking questions about it, and therefore time to look at these disclosures. So important around risk, we have to consider physical risk, especially around climate change, transition risk, moving to a low emission technology, and also, you know, the compounding effects of other risk, credit risk, market risk, operational risk, insurance risk, liquidity risk, reputational risk. So as you try and obtain new insurance, you know, renew insurance, to what extent is there a requirement to have sustainable practices and to prove that you've got sustainable practices? So if you have a big picture look at the TCFD disclosures, so this is just looking at climate, but similar principles apply to all sustainability related disclosures. It's disclosures around governance, disclosures around strategy, risk management, and then your specific metrics and targets. And I've given you some examples here. So really important to consider, how do you incorporate sustainability related disclosures in 31 December 2022 financial statements. So I'll take a quick break because I feel exhausted how fast I'm already going, Kevin. So we move on to transitioning from special purpose to general purpose financial statements. So we know that 30 June 2022 really saw the end of special purpose financial statements in a big way. A few could survive, but as soon as you are preparing special purpose financials, I think it's important that you consider, do I have a position paper to continue to support the preparation of special purpose financials? Because from absolutely everywhere, there's pressure to get rid of it. So whether it is SGE requirements, whether it's requirements by the AASB, etc., pressure to get rid of it. So this is a recap of the new requirements. If financials are required by legislation and they refer to Australian accounting standards or accounting standards, you have to do general purpose financials. And if your constitution or your documents, your trust deeds are created or amended after 1 July 2021, and it still refers to Australian accounting standards, you have to prepare general purpose financials. And we've got an article here outlining changes to a constitution and banking arrangements from 1 July onwards may trigger the preparation of general purpose financials. So please consider that if you're in that category, to make sure you don't fall in that trap. Then the other thing, to just make crystal clear, if we talk about general purpose financial statements, we mean consolidated financial statements. It goes without saying. If you are preparing general purpose financial statements and you control another entity, you have to prepare consolidated financial statements in accordance with IFRS 10 or AASB 10. There's no two ways about it. So it's really important that you can no longer avoid the preparation of consolidated financials if you've got control over one or more subsidiaries. The exceptions are really just if you're an intermediate parent entity. So unless you're the ultimate parent entity, so the ultimate Australian entity, even though they are an intermediate entity and there's other entities up the chain, the ultimate Australian parent need to prepare consolidated financial statements to lodge with ASIC. However, the entities below, the intermediate entities below, if they meet the criteria in AASB 10 paragraph 4A, they don't have to prepare consolidated financial statements. So again, please make sure that you meet the criteria, that you're not the ultimate Australian parent. So before you move away from consolidated financials, make sure that you're allowed to. So again, we've written an article to explain that a bit further. So you cannot say I've got general purpose financials, I control another entity, but I'm not consolidating them, right? Consolidation is not excluded. Then for entities that continue to prepare special purpose financials, somehow you can still continue and you're happy that you've considered all the options. AASB 1054 have included disclosures for those entities that continue to prepare special purpose financials. So we've included here the disclosures that are required, so please look at those. And we've got an article again on the disclosures required by for-profit entity that continue to prepare special purpose financial statements. So, please make sure that you address all of these. The next related topic is AASB 1060, simplified disclosures. Now, as you know, if you prepare general purpose financial statements, for for-profits, there's a tier 1 and a tier 2. Previously, for tier 2, you would have done RDR, reduced disclosures, and now you would do a simplified disclosures because reduced disclosures have been removed. So you look at AASB 1060. So if you transition from special purpose to general purpose financial statements, usually, not in all instances, but usually you will transition from special purpose to general purpose tier 2 which would mean AASB 1060 disclosures. And if you've previously done general purpose tier 2 and you've used RDR, you'll now do general purpose financial statements tier 2 and AASB 1060 disclosure. So that will be a big change again. You know, it is important that you consider, you know, whether you've done all the recognition and measurement requirements in the past, and, you know, is it only additional disclosures that's required, and what about comparative information? So we've given you some guidance here on what are potentially the additional disclosures that have to be captured. So if you've done all the recognition and measurement under special purpose and you go to general purpose tier 2, potentially there's just additional disclosures under AASB 1060. The big assumption behind all of that is that you've previously done all the recognition and measurement, including you've consolidated where required. And often that's the problem. So if you've not previously applied all the recognition and measurement, for example, you didn't consolidate, or you didn't do deferred tax, or you didn't fair value certain items, you can either transition using AASB 1 or apply IAS 8, you know, to move to the tier 2 requirements. And again, we've written 2 articles explaining the relief when you go from special purpose to general purpose using AASB 1, and then also, you know, a little bit of an explanation of some of the transition disclosures that we've said they are not so simple. So there's additional articles for you to look at. The next thing to consider is related party transactions. So if you go from special purpose to general purpose and you have to comply with AASB 1060 disclosures, you'll see there's quite extensive requirements around related party transactions and related party relationships. So the details of key management personnel compensation have to be provided in aggregate. You have to disclose details around transactions with these related parties and also balances with related parties outstanding at the end of the year. Now, there's a few tricks and traps around these. Again, we've seen this is one of the very difficult areas when you go from special purpose to general purpose tier 2. So we just want to highlight it's not that easy. Make sure you consider it appropriately. The AASB very deliberately decided to include extensive disclosures around related parties because they believe that would enhance true and fair presentation, and therefore it's important that we realize it's not negotiable, and that, you know, we have to prepare and gather the information, and obviously the auditors will also look at this very carefully. And again, we've got some articles. So who is a related party, a bit of an update on that. And then we've simplified disclosures, exactly what information is required. So it's not as extensive as AASB 124 for tier 1 entities. There are some relief, but it's important to know exactly what's required. And then we've also included references to our topic page around the related party disclosures. So if you want to know more about the full IAS 24 or AASB 124, you can have a look. And then obviously AASB 1060 have very specific disclosures for entities that do general purpose tier 2 financial statements. In the next section, we want to look at standards applicable to 31 December 22 annual periods and half-year periods. Now, I mean, the big change going forward in the IFRS world is around sustainability disclosures, IFRS S1 and S2. However, there's a few other changes. None of them are earth-shattering. Not all of them would apply to all of you. However, we thought we'll put a list together of the things to consider. You'll see here for annual periods, AASB 1060. There's amendments to Australian accounting standards, removal of special purpose financials for certain for-profit. There's still COVID-19 related rent concessions and disclosures. We've previously talked about interest rate benchmark reform. Sorry, let me just remove this. I've clicked on the wrong button. Why is it not going up? Anyway, and we've got, I lost my thought now. COVID-related rent concessions. We've got extending transition relief under AASB 1, and again, some amendments around special purpose financial statements. If we particularly look at AASB 2020-3 amendments, a number of amendments we wanted to pull out, changes around IFRS 1, IFRS 9, the 10% test, whether we've got a new or a modified liability, IFRS 16 deleted illustrative example 13 around reimbursement of leasehold improvements, and changes to IAS 41. Also some changes around the conceptual framework and changes to IFRS 3. The one that we've talked about in our May update was onerous contracts and changes around cost of fulfilling a contract. So it's amendments to IAS 37, and they've added a new paragraph 68 capital A. And we also previously talked about property, plant and equipment, proceeds before intended use, and that we will no longer use those proceeds to reduce the cost of the property, plant and equipment, but instead it would be included in profit and loss. So both of these amendments we've talked about in our May accounting standards update. Briefly, IAS 31, there's an explanation of what exactly are these unavoidable costs. So when you look at a contract, you want to assess whether a contract is onerous or not. You look at the economic benefits and you compare it with the unavoidable costs. And there's always been some question around, what exactly should be included in unavoidable costs. So if the costs exceed the benefits, we immediately book a provision for that onerous contract. So paragraph 68 capital A has been added to IAS 37, and it says cost of fulfilling a contract comprise costs that relate directly to the contract, which include both incremental cost of fulfilling the contract, so those direct labor and material costs, but it also includes the allocation of other costs that relate directly to fulfilling the contract. So examples would be an allocation of a depreciation charge for property, plant and equipment used in fulfilling the contract. They've also included transitional provisions. So if this is the first year you are applying the standard, there are transitional provisions. So you could look at that if this impacts you. We've got a brief example where we've said in the olden days, we might have excluded the allocation of depreciation, allocation of insurance, management salaries when we did this assessment. And if we've excluded that, it might have led us to believe that it's not an onerous contract. However, now, if we include it, you can clearly see we've got an expected estimated loss, and therefore we'll have a provision for that 100,000. So it's quite a significant change. And really the key message here from a commercial practical perspective is that to be alert for unprofitable or thin margins contracts. So look out for unprofitable or thin margin contracts, or ones where the costs have changed significantly without an associated increase in revenue. For example, as a result of supply chain disruptions that we currently see. So such contracts may be onerous even before the amendments to IAS 37 are considered. So I think this is just a reminder, if you look at the general economic conditions, look at contracts really carefully to potentially identify these onerous contracts and be aware of these new requirements. the new paragraph 68 capital A. And we've got an article to explain this. Supply chain disruptions, higher prices, and accounting standard changes. What does this mean for 31 December financial statements? So we try and pull it all together in our corporate reporting insights that was released earlier this week. If you look at the other one, property, plant and equipment, as I said earlier, instead of reducing the cost of the property, plant and equipment with the proceeds from these items that we're selling whilst constructing the property, plant and equipment, or whilst testing the property, plant and equipment, instead we will now recognize it in profit and loss. And it's important that if you book the sale in profit and loss, you should also have a cost of goods sold, and you look at IAS 2 on how do you determine that. So again, there's some additional disclosures being required, and the effective date is for annual reporting periods on or after 1 January 2022. So definitely for 31 December, this is effective, and you need to look at this. So what's important is the accounting treatment has changed, as well as these additional disclosure requirements. Also, transition requirements. So whenever we have changes to accounting standards, often we have some transition requirements. This one is no different, and therefore, how can we do a transition? So that's important to consider. Again, we've got an article in this month's Corporate Reporting Insights, proceeds from selling items before the property, plant and equipment is ready for its intended use. And the question is, do we deduct it of the cost of the PPE or recognize as income? And as I've just explained, you recognize it as income, and it's got some follow-on consequences. Then the next one, amendments to Australian accounting standards. They've extended transitional relief under AASB 1. So they've extended relief in 2 areas, and this is an amending standard that was issued earlier in this calendar year. So it's AASB 2022, number 2. So they've extended relief in 2 areas, and this is subsidiaries that are preparing general purpose financial statements for the first time later than the parent. So the parent had previously done general purpose financials, but now the subsidiary is also transitioning to general purpose financials. There's some relief available. And then also, if we've got non-reporting entities preparing separate general purpose financial statements required to prepare consolidated financial statements at 31 December. So previously, you've done separate general purpose financial. Now you have to do consolidated financial statements. The only reason you got away with these separate general purpose financials that were not consolidated is you were not a reporting entity in the olden days, so you were basically doing special purpose financials. General purpose financial statements by definition would always be consolidated. It's something that's happened in the past, because in the past some entities argued that consolidation is a disclosure aspect, and although they've done all the recognition and measurement, they didn't have to consolidate. Now that has been closed down, but if you're transitioning from that position, there's some relief, and an example would be country by country reporting entities. Again, we've included an article around AASB relief for entities transitioning to simplified disclosures. If we go on and we look at standards issued but not yet effective, and as you know, according to IAS 8 paragraph 30, we have to disclose information about these standards that's been issued but they're not yet effective. So we have to disclose the fact and a known or reasonable estimate of how it would impact the organisation. And then there's additional requirements in paragraph 31 on things to consider to include in that disclosure. So the standards we're talking about, it looks like a long list. Yes, it's a long list, but the big ticket item is AASB 17 insurance contracts, or IFRS 17 insurance contracts. And we know that the start date was deferred from 1 January 2021 to 2023. You know, AASB 17 also impacts corporates that accept insurance risk in their contracts. So that's a big ticket item. The other ones are amendments to standards. You know, the first one is classification of liability as current or non-current, or disclosure of accounting policies and definition of accounting estimates, deferred tax related to assets and liabilities arising from a single transaction. The next one is around disclosure of accounting policies, Tier 2, initial application of AASB 17, illustrative examples around not-for-profits, and then lease liability in a sale and leaseback. So it looks like a long list, but it's quite bespoke standards or bespoke aspects, except for AASB 17, and even AASB 17 only applies to corporates in if they have included or accepted insurance risk in their contracts. So we've got a bit of a few slides providing an overview on each of these. I've included this so you can have a look to what extent it applies to you. We've got resources about insurance, a number of articles that Dean Arden, our insurance expert, have written on how insurance could apply to corporates and when it would apply, and we even had webinars on it. So if you're worried about that, have a look at that. These are all the articles that Dean has actually written over the last 2 years around insurance and the impact on corporates. So we've focused on corporates and we haven't focused on insurance companies as such. The other standards, this is a quick overview of those more bespoke amendments. If you wanted to have a look at those, there are articles explaining them further, so you can see whether any of those would impact you. There's a great publication issued on the deferred tax amendments that you could consider with worked examples. Obviously, articles explaining it, and again with the sale and leaseback, the lease liability in a sale and a leaseback transaction. There's BDO publications, there's corporate reporting articles, and a bit of an overview. So if any of those impact you, please read more and reach out if you need assistance. Kevin, I'm keeping an eye on the clock. I'm going to push ahead. Changes to IAS 1, classification of liabilities. So this is the latest change that came through from the International Accounting Standards Board. I think previously we talked about this. We've got the current IAS 1 or AASB 101. Then there were changes approved. Then there was an ED on the changes. Finally, they've sorted it out, and we've got the final version of IAS 1. Now, this final version of IAS 1 is not effective yet, and the new IAS 1 talks about, 4 key issues. So it addresses a situation where the right to defer settlement need not be unconditional and must exist at the end of the reporting period. They discuss classification based on the right to the defer, not the intention. They talk about liabilities settled by transferring own equity instruments prior to maturity. For example, that we see in Australia would be convertible notes. And then there are additional disclosures where the right to defer settlement is subject to the entity complying with covenants within 12 months after the reporting period. This was number 4, was a real big problem area and subject to multiple changes. And hopefully we have a final position now. Again, we've got a number of articles looking at this. So there are links to the articles. And this is our latest publication that came out a few weeks ago, looking at the non-current liabilities with covenants, which was the problem area, and some examples, really good publication to look at. So this is not effective yet, but I think it's important to consider this as you enter into new arrangements, new financing arrangements, how it would impact your disclosures in future. Then the Russia-Ukraine conflict, it's a reminder that there are a number of considerations There could be going concern uncertainties. There could be impact on classification of liabilities. There could be impacts on assumptions used for estimates. There could be impairment of inventories or other assets. We have to disclose the nature of the refinancing of borrowings. There could be subsequent event disclosures. There could be recoverability of deferred tax assets. There could be provisions for severance pay. There could be foreign exchange volatility. There could be restructuring and onerous contracts. We could look at the modification or cancellation of share-based payments. There could be assets held for sale and discontinued operations. There could be impacts on the measurement of fair value. Reduction in earn-out liabilities as part of a business combination. We should look at whether revenue contracts have been modified as a result of this conflict and whether lease contracts have been modified. So we're saying if you have seen an impact as a result of this conflict on one of your subsidiaries, on your business, some of your suppliers, some of your customers, these are the kind of things to look out for. You know, the world is so small these days. Something happened between Russia and the Ukraine, and it impacts all of us, even down here in Australia. And we've got an article looking at that as well. Now, Kevin, I have talked so fast. I hope I've left you enough time to look at the next sections. I'll hand over to you on listed entities.
Thank you, Aletta. You've done well. Have a drink of water. As often, Aletta's done a great job. I would probably just remind everyone at this point, and I hope I got this right, Aletta, I actually think this webinar is a half an hour longer than our traditional 1 hour webinars. We do that traditionally at this point because there's a lot to cover. So for those of you who are listening in, just a reminder, this will go on until 12:30 p.m. on the East Coast time zones, or at least the East Coast time zones that matter. So moving along to listed entities, what I'm going to do from this point forward is give Aletta a break, first of all, but also just start to talk a bit more broader outside of the accounting standards. So we're looking a little bit more broader in terms of listed entity regulation, ASIC regulation. There's a little bit of craziness going on between New Zealand and Australia, so I'll have an Australia and New Zealand development update. I'll start with the listed entities. Now, some of the stuff, as Aletta's pointed out in her section where she was dealing with some of the accounting standards, is quite bespoke, but then there's other stuff that actually does apply to everybody. So, you know, we've got some stuff at the listed entity level where there are changes to oil and gas reporting in terms of revised listing rules and so forth. I'd like to believe that if you're in this industry, you'd be aware of that. I mean, obviously it's quite bespoke, but if you're not across that, there were certain reporting requirements that came into effect July 2022, and disclosures are sort of rolled on for the listed entities. The one I'll probably focus on is the one below that, which is the failure to lodge financial statements on time. Now, I gotta be honest with you, I didn't realize how big a problem this was until this year. It really was interesting how many entities, actually listed entities, do actually push right up against that failure to lodge their financial statements on time. So as of 31 January 2023, for listed entities that are failing to lodge their financials on time, will be automatically suspended from trading. And there are very specific rules around the lodgement of the market with the Market Announcements Office, closing on the day when the report is due, and how that will actually impact suspension on the bourse before trading commences on the next day. We've even got on the slide there when the office is open. Please be aware of this. This is a governance issue so much. It's not so much an IFRS issue or an accounting standards issue. It's actually a governance issue, and the ability of the entity to get their financials lodged on time, part of, well, I wouldn't say it's part of continuous disclosure, but it's actually part of the ability to communicate through the market with your investors and actually meet some of these regulatory requirements that are required by the ASX and so forth. Take this on board, because this requirement isn't, or this new requirement isn't so much because they're trying to be a bit vague or a bit funny. It's actually because there are a lot of entities actually fall into this bucket. And the ASX are actually taking a stand on this one. So make sure in your governance processes that you've dealt with this one, that you get this online, and don't push up against this this lodgement date and cause suspension. The knock-on effects actually can be, you know, quite important. I think I'll leave it at that. that's something to communicate into your investor relations teams and corporate reporting teams. As always, Aletta's got some links to the articles that we have on here, and you can click through to those, especially if you're in the oil and gas reporting and you weren't aware of those. There's a nice article on that you can go find on our website. Moving forward then to recent IFRIC agenda decisions. The IFRIC agenda decisions and I have a tenuous relationship at best, because as you'll see on the next slide, they're not authoritative standards per se, but they really are. I mean, there is an expectation now, if not a vague requirement, that these actually will be applied. I mean, generally speaking, if you've got the fact pattern that went with the example in an IFRIC agenda decision, it applies. It needs to be applied. There's no start date on that, but once these are issued in final format by the interpretations committee, they provide you additional information on what's required. But really, if you're not complying with the same accounting process and accounting outcome for the same fact pattern, it really is a change in policy at that point when you actually have to adopt it and bring it into your accounting. The trickery involved here is that it's not like accounting standards which have an effective date and a start date. These things, once they're published, essentially are effective. Now, the practice involved there is to implement it, pretty much once it's effective. But if you don't affect it once it's in play in your reporting period, then by the time you get to your next reporting date, you're actually going to have an error that needs to be affected. The trick with IFRIC agenda decisions is that it's not like these things arrive and are suddenly a surprise. These things go through exposure processes, just like any type of transparency with the international standard setter. So the agenda of the IFRIC committee is pretty much published out there. The examples are published. The thought pattern from one meeting to the next is actually published as well, meaning you don't need to wait till the last finalization of the actual decision to suddenly become aware of this issue. Many of these issues are actually in play for months, if not years, until final decisions are made, meaning you need to keep an eye on them and make sure you factored them into your accounting processes, and actually build them in and start to sort of sense the change in the wind, let's face it. Why I'm making a big deal about this is I think the industry was pretty much blindsided, or many organizations were blindsided in the last 18 months by the software as a service in IFRIC agenda decision. Everybody got really surprised by the fact that certain costs which were incurred in terms of setting up a SaaS environment suddenly couldn't be capitalized. Yet the issue had actually been on the agenda of the interpretation committee for something like 2 years before they finalized those decisions, and then there was a mad scramble to try and deal with the accounting around that. So the point I'm making with this slide is just be aware of what's actually on their agenda. Don't wait till these things are finalized. Watch them as they're coming. And as I said, once the decision's made and the fact pattern applies to you or is relevant to you, you really should be building that in, pretty much immediately and effecting it as a voluntary change in policy to avoid an error come the next financial year. ASIC's expectation is pretty much what I've just discussed, which means they're watching this as well on, and at the entities that are being monitored. And you just want to get this stuff right. It's also a governance issue, pretty much make the ability for you to roll these things in. I'm making reference to governance in terms of these sessions because corporate reporting isn't just so much about getting your accounts ready for publication in the last 3 weeks before your lodgement deadline. Governance, it started to become more about corporate reporting governance, which flows into risk management, which flows into both business strategy, and everybody's favorite word, including Aletta's right now, sustainability at that point. So there's a bigger issue at play here, getting your systems and processes, locked down to actually deal with these things. With that said, I'll have a look at the quick IFRIC agenda decisions that are currently in play. There's a couple of them that have come out, I think on the next slide, Aletta. Oh, there they are, sorry. Negative low emission vehicle credits, public shares for debts and equity in special purpose acquisition companies. So we've put them by date. Transfer insurance currency under group annuity contracts, multi-currency groups of insurance contracts, and once again, your warrants for SPACs. Now, we're not going to deal with these specifically or in detail in this session. There are links to contracts. I will deal with the loan forgiveness of lease payments on the next few slides. Before I get into those, there's links here. I just want to kind of put it out there. Anybody dealing with special purpose acquisition companies, so-called SPACs, this is a hot topic internationally, but also becoming a hot topic in Australia. You'll know what a SPAC is because you'll be dealing with it when you hit there. So if SPAC is in your vocabulary and you're actually dealing with it, the answer to you right now is just get some assistance with the accounting implications that flow from that. Believe it or not, it's not as simple as you think. Everybody think it's easy and it's kind of a start fresh and a fresh start accounting, and this can't possibly be difficult, but it is. There are some unique IFRS or corporate reporting implications of SPAC, and you can see that by the number of times it's appeared on the list of IFRIC agenda items. So I'll leave those links with you. I will deal with the loan forgiveness of lease payments. This because Aletta's favorite topic in the world, leasing, and so we'll deal with it. But it's also because it actually does impact really everybody. Everybody who's entered into a lease is going to have some sort of implication along the way, whether you are the lessee or the lessor. The other reason why we're putting it up is because it actually did answer from an advisory point of view in my line of business and Aletta's line of business in advisory. We often get questions on how the lease accounting standard interacts with the other standards. Now, this was a very specific question having to deal with a lessee that was experiencing financial hardship. There was a rent concession with lessors. The lessor actually had some outstanding payments that were already past due that were actually sitting on the balance sheet as a receivable. And then there was a rent concession given because of the hardship that the lessee was experiencing. And they made changes to, what needed to be paid. They pretty much amended or modified the contract, but also made concessions about past due lease payments that hadn't actually yet been paid by the lessee. Now, very specific fact pattern. So it doesn't necessarily always apply to everybody. It's an interpretation, which means there'll be a question with certain facts given, and the interpretation committee will render an answer on it. So it won't always apply to everybody because not everybody will have the fact pattern. But what was interesting about this particular interpretation is they answered in a very indirect way some of the questions we and the industry were having, and I know Aletta and I had spent hours on the phone on this sometimes, talking about how does the lease accounting standard interact with the financial instrument standard. That was the part that was interesting for me, because if you haven't recognized it in your lease accounting, is that once you've recognized certain assets and liabilities on your balance sheet, and I'm talking about lease payables as a lessee and lease receivables as a lessor, especially if the lessor has capitalized those as lease receivables, you're then into the world of financial instrument accounting, because under AASB 9. And there were certain holes in the way those two standards interacted with each other in terms of derecognition of liabilities and derecognition of assets. This interpretation has sort of answered some of those questions. There were two questions posed. I'll jump to the next slide later. Basically, in answering this question, the interpretation committee the question they were asked was, how do you apply the expected credit loss model to the lease receivable? Now, the ECL model under IFRS 9, and they actually pretty much spoke, yes, you would go into IFRS 9 or AASB 9 and you apply the ECL model, but they also spoke about derecognition of the receivable under IFRS 9. So this gave me a clue to the standard setters, the way the standard setter approaches the standard, which is basically you do need to go to IFRS 9 when you're dealing with derecognition on some of these lease payables and lease receivables. They haven't answered all the questions, but I think there's a hint in this interpretation that the interaction between lease accounting under IFRS 16 and IFRS 9 do actually apply at the same time, which on the next slide, Aletta, was actually question 2. Pretty much that when you dealing with the rent concessions in this example, you actually do apply IFRS 9 and 16 at the same time. That's a big hint, because that's a complexity in accounting. Aletta and I always say that IFRS specialists are those specialists who can actually understand how to actually apply different standards at the same time. They live in the world of the scope paragraphs. Which standard am I in, and which standard am I applying at one or more times, and then which standards do I apply at the same time. And this is a great example of that. You've got this complexity of movement between two standards. The answer to this one was that when the rent concession was given, one is you do actually de-recognize the operating lease receivable under IFRS 9, because you're actually forgiving, or you're changing a financial instrument, a contract, by actually de-recognizing it because it's no longer due. But at the same time, you have to actually do the modification of the future lease payments in the rent concession agreements actually is treated as a new lease under IFRS 16 or AASB 16. Now, I'll stop at that point, because if I've confused you, then great. At least I've told you this exists. It's a very interesting discussion. It went on for some time. They finally came to a conclusion, and they answered a whole bunch of questions about various standards interacting. But really, it's a matter of changing to modifying lease contracts or lease arrangements actually can give rise to a new lease under 16 in terms of accounting, but also you've got derecognition and ECL being accounted for under IFRS 9 or AASB 9. Fairly interesting answer, but also it is the sort of question that applies regularly. And it's not only a rent concession where that may have relevance, because there are changes and agreements between lessor and lessee gang happening all the time in these sorts of contracts that need to be looked at. Okay, so there's an article there, and you can go and have a look at that one. I'll move on then, in the interest of time, to our ASIC update. So now we're looking at the ASIC update, Australia corporate update. Have a look on the next slide there. These are the topics we'll cover, and I'll run through some of them more briefly than others. When it comes to extension of reporting deadlines, it's very unlikely we're expecting an update or an extension of reporting deadlines sort of beyond the December 22 years. I don't think government wants this to become an entrenched expectation, but it also means that if you relied on the extensions in the past, you need to start to walk that back, or prepare to walk that back. For some reason, a lot of companies, when they got the extension, we did struggle, sure, during COVID, but they've entrenched that deadline into their governance and into their resourcing, and they may be caught out by the fact that the returning to norm may catch you out. It's amazing what 1 month of extension can do in terms of expectation. So we'll go with that. Large grandfathered companies. This was one of those scenarios that actually had become entrenched in the fabric of Australian corporate reporting. So large grandfathered companies, I won't get into the details here. You'll know if you're a large grandfathered company because you would have been grandfathered. Pretty much snuck in to the Treasury Law Amendments Bill in August 22. The reality was, it wasn't actually that much of a surprise to those in the know. This had been on ASIC's radar for some time. They just finally got it actually entrenched in the legislation. And the implication means that large grandfathered companies, let's say with a June year end, will be lodging their accounts by June 2023. The reality, though, is that these companies are also impacted by the move from special to general purpose, meaning they should already be, in June 22, have transitioned at least to Tier 2 reporting general purpose. You shouldn't be hiding behind the fact that you aren't lodging by not actually complying with the other requirements in the corporate law, which is special purpose is dead, general purpose is where you are, and you'll be lodging those come your next lodgement period, which will be June 2023 for the large grandfathered company. I think that's probably all I'll say on that at the moment. There's links to this as well. We've put some definitions on here, so you can go and have a look at them. There's the links to the articles. We had 2 articles in recent months. Virtual AGMs, I think this is a move from COVID. We're all happy this is happening. May require some changing to your constitutions and so forth. I think we're accepting that the corporate law and the regulation was catching up with the fact that we all live in a Teams and a Zoom world now, and so we'll take it from there. All right, focus areas for ASIC. Focus areas for ASIC, what this means in our corporate reporting parlance is, what are they looking at in corporate reporting? What are they challenging companies on? Sending letters, asking questions, and actually pushing back on whether we've actually complied with these sorts of things. ASIC does this as a matter of course. They put focus areas out. I think, Aletta, you're going to deal with these later on down in the back end. But there's two I'd like to point out here, and that is for the non-disclosures of business risks in the operating and financial review for listed. So I'm probably talking to our listed entities here. Once again, a governance issue. Once again, a sustainability issue, because your operating and financial review focuses on matters such as business strategies, prospects, and business risks. Those are the sorts of things that you will see even BDO sort of started to refer to in our sustainability report, which Aletta dealt with right at the beginning of this webinar. And so they're the sort of things that are starting to come into financial reports, whether you're doing a sustainability report or not. In your operating financial review, it's those types of discussions. I mean, really, it's bringing your investors and the people who are looking at your financials pretty much into the boardroom to get a flavor of what's going on in terms of strategies, prospects, and risks, and making those disclosures in your operating and financial review. ASIC has focused on this in the last few years, and when we get to the list of queries that ASIC had for particular companies, you'll see it's number one on their list. And they've been focusing on this and challenging companies to improve this disclosure, issuing please explain letters, and then it becomes a bit of a tussle between the company and ASIC to make sure that these disclosures are made properly. So from a governance point of view, I'd like to encourage listed entities to focus on this. It's not just a compliance exercise. This is useful information that gives an insight into the boards, gives an insight into the risk processes, and actually is included in that review and in your financial reports and annual reports. So I'd just like to point that out as a key focus areas. On the focus areas that are more the things we've come to expect, impairment and so forth, provisions, solvency and going concern assessments, I'm going to leave this slide as res, but I will actually just say at a higher level that the one thing that I have seen, at least in my client's assessment at this point in terms of focus areas, is pretty much the impact of a rising interest rate environment and inflation. And I guess that also extends to supply chain issues which flow from the Ukraine-Russia situation. These things are having an impact. I'll take impairment as an example because, like Aletta loves leases, I love impairment. Those are our two, areas of love. It's really become interesting that companies and finance teams and CFOs don't know how to budget and impairment assess in an increasing interest rate inflation environment because it hasn't happened for so long. We've lost the ability to understand how to budget in those areas, how discount rates are impacted, and that flows to provisions, to expected credit loss, and then to going concern and so forth. All these things are impacted by issues that are happening in the world, and ASIC is focusing on all of them and how it affects all of these issues: disclosures, subsequent events, solvency assessments, provisions, and so forth. So if I had to say, if there was one thing to focus on here, it's a whole of entity assessment of how the world's events are flowing into all of these things. Is really, from a governance point of view, I would encourage directors and CFOs to be looking at in the focus areas. Don't just approach these in isolation. This is a whole of entity assessment across the board with environments changing. I think I'll leave it at that. I think Aletta's going to cover some of this at the end of the session again. Here's the results of the ASIC surveillance as they currently stood at the end of December 21, and notice at the top, operating and financial review was number of inquiries from ASIC was pretty much at the top, then impairment, followed by provisions. Pretty much everything we've just spoken about in terms of a whole of environment assessment of those things. And these are governance issues at the top. These are not things you should be leaving your financial controller or finance team to try and solve. The three things at the top of this list pretty much are tone at the top and they flow down. Because if the entity can't see these as business risks, then the finance teams can't deal with them in terms of how they prepare financial statements. I think maybe I'll leave it at that. Moving through then to AFSL licenses. This is an interesting slide. Also won't get into it here because it really only applies to you if you have an AFSL license, but there was a bit of craziness going on at some point between the Chapter 2M requirements and the Chapter 7 requirements. You'll know what I mean if you have an AFSL license, especially on the Chapter 7 side. because of also the change from special purpose to general purpose and consolidation being required for the first time, this stuff all had to flow through into the AFSL world. There was a lot of articles in the last year, and eventually some of this has been aligned. The FS70 reforms have been updated, and I think the transitional hiccups have mostly been ironed out now. I would just say that if you haven't looked at this for the last 3 or 4 months, go and have a look at these 2 articles, because they update previous decisions that ASIC was making in the last 18 months just to get everything online. So just make sure you're across this before you launch yourself at it. Aletta looks like she wants to put her hand up.
Yes, Kevin, I've got the physical hand up today. You know, if you've got an AFL license, it's important to look at these articles. Included in the articles, we've got some significant decision trees that really deal with this matter quite significantly. So if you've got requirements under Chapter 7, requirements under Chapter 2M, maybe requirements under both, what does public accountability mean? It's really complex decision trees, so we couldn't deal with it here, and it doesn't impact everybody. But we've written significant articles, and if you're looking for advice, please contact us. At the moment, we're doing quite a bit of advice in this space because it's different and it's new and high risk.
And Aletta's making reference to the decision tree because Aletta loves a decision tree. And that's great IP that we're handing over to you to use. So go and have a look at this, because trying to figure it out by reading the regulation yourself, it's just not easy to understand. So the decision trees are really useful. Okay, I'll run through some of these really quickly. So there has been a change to some of the financial instruments, the corporate reporting instruments that ASIC uses in terms of rounding. These were required specifically to deal with corporate collective investment vehicles. There were some changes, but also to deal with those entities transitioning to Tier 2 general purpose and simplified disclosures. I mean, it's really dealing with when can you round to the nearest thousands, and also when can you round to the nearest cents, or should you round to the nearest cents for share-based payments. I'm actually not going to cover this in detail in the interest of time. On the slide and also on the next slide, there's some information there, but the short of it is, if you're Tier 2 general purpose simplified for the first time, just check if you are rounding up to $1,000 in your reports or dealing with share-based payments. Just go and have a look at this article to make sure you're not running foul of the instrument. I think that's probably the takeaway from this, is make sure you're across it. On the Australian developments, I'll whip through this quickly. The Australian developments, look, so there's some country reporting entity, there's some tax disclosure information coming on a country by country. That's coming out of the OECD initiatives and global tax and multinational tax type initiatives. I'll show you those when we get to them. Classification and employees and contractors for employee benefit provisions and director ID requirements. Let's just whip through these quickly. In terms of the tax disclosures, this is, as I say, coming from the OECD work. I almost want to say that if this impacts you, you'll know it impacts you already, or you'll be part of a group that knows it. They're Pillar 2 type rules. These are dealing in terms of the 15% minimum global tax rate. It doesn't impact everybody. It's quite niche, but if it hits you, and it's going to have an impact. I would say that your tax consultants or tax lawyers and legal consultants should be across this. But what you need to do here is link those parts of the business and your governance structures with the corporate reporting side of things. On the next slide is really where the good stuff comes in Australia, which is for Australian entities with groups with approximately 1.1 billion AUD, and we sit approximately there because we're dealing in euros here when it comes to rate conversions. If your effective tax rate is less than 15%, you may be impacted by the so-called Pillar 2 top-up tax requirements, and there'll be disclosures there. Like I say, start with the lawyers and the tax consultants, and BDO, of course, has tax partners and tax teams who deal with this. It then just flows through to the disclosures, and it's actually coming out of the OECD thing. So this is not going to be found in an IFRS statement, IFRS standard per se. All right, jumping through the next thing there. Oh, nice article there. Sorry, you can go and click on that. On the employees and contractors, pretty much the same flavor as the one before. It's a legal thing that flows through to a governance issue, that then flows through a corporate reporting thing. The corporate reporting impact here is you're going to have employee benefit type disclosures. But where it starts with is understanding your employees versus contractors. So that's a legal determination. Making sure then that you understand which bucket they're in. You might think they're a contractor, but they may actually be employee, and the other way, and vice versa. This comes from 2 legal cases we've put up here. I'm not going to claim to be a legal expert. On the next slide, Aletta has put in some two legal cases that have an implication here. That's why I say start with the legal side of this. But I think if you're sitting in a finance team or a CFO and you're not quite legally au fait, the question really is, if you've got contractors, you need to make sure that in terms of the legal determinations, you've got the tax right, their classification correct, and then does that flow into the correct level and a disaggregation of your employee benefit disclosures from an IFRS and a corporate reporting point? That's the second case that Aletta was that I was referring to, that Aletta put some slides in. And then on the next slide is just the takeaway, which I think is our link to our article on the website. Sorry, this is pretty much what I've just already said. You can go and have a look at that in your own time. Finally, on the ASIC is the director ID requirements. Now, a word of caution here. Be careful not to assume that if you're not a listed entity or large proprietary company, that this doesn't apply to you. And I can say this from some experience, and Aletta, you'll be the same. Aletta and I will be directors of companies in our own right because of our partnership structuring. We've got family trusts that go on, and you've got a trustee company that looks after that. If you are a director of a company, and that includes if you are, let's say, a director of a trustee company for your family trust, this applies to you. It also applies right up to any director who's on a big listed company or so forth. Any director of a company must get a director ID requirement in play. This has been around for about a year. I keep getting emails about this, and true to form, I kind of left it until a few weeks ago because the deadline is now coming up on us, 30th November. It's a regulatory thing. It's linking your MyGov account and your director information to getting an actual ID. That is pretty simple, but if you don't do it, there are penalties. Get this organized by the 30th of November. The trigger here is, are you a director of a company in any company? Even if it's just a company that is the trustee company, let's say for your family trusting, this applies to you. Go and solve this.
Kevin, and it also applies if you're a director of a not-for-profit. So, as you know, I've been a director of a not-for-profit, and, it therefore applies as well. So it's really quite wide.
That's right. It's really a couple of clicks. I must admit, when I got this to do, I didn't understand the instructions the first time around. They looked a bit more complicated than I thought, so I put it in the too hard basket for about a week. But it actually wasn't as hard as it seemed in the end. It's really just a couple of clicks, and it's linking a couple of databases, and that's so much easier than the penalty. So off we go. New Zealand developments. Quickly on this one, this has got an Australian flavor to it. So the new what's new in financial reporting in New Zealand is large companies are required to file audited financials with New Zealand. I suppose that's not new per se. There's some adjustments to the actual revenue and asset thresholds because of inflationary, but the flavor of the day for the Australians is, if you're an Australian group with a New Zealand subsidiary or an Australian entity that have a New Zealand branch and they're large, you're going to have to comply with this. So just make sure you've navigated this. Do I have this? And do I meet the thresholds, and do I need to lodge as a large? That's pretty much the order of preference here. I think we'll leave it at that. We've put some of the old and new thresholds here for information purposes. Once again, this governance issue, if you've got a New Zealand branch or subsidiary, you should be reacting to this. And I guess if you're in New Zealand, you should obviously be reacting to this just for any large company because it applies to you as well. I think that probably covers all the bits and pieces. I will say thank you very much and hand over to Aletta to round us out for the last 8 minutes of the day.
Thank you very much, Kevin. So hyperinflationary economies. So this is important because if you have a subsidiary or if you operate in a hyperinflationary economy, and we have a separate standard dealing with the conversion of the exchange rates to Australian dollar, for example. And therefore, it's important to know which entities and which countries would be deemed hyperinflationary economies. So as at 31 December, we had Argentina, Iran, Lebanon, etc. Zimbabwe, close to our old home country, Kevin. Then economies which have become or are expected to become hyperinflationary in 2022. Turkey from 30 June onwards, Ethiopia expected from 31 December this year, and Sri Lanka expected from 31 December this year. Economies that have a risk of becoming hyperinflationary, so they're on a bit of a watch list, would be Angola, Haiti, and Liberia. So important to know which of these countries are hyperinflationary economies. If you've got branches, activities, subsidiaries, they're important to consider the accounting implications. So in our article, we've explained why does this matter for your financial statements. So again, it's in this month's corporate reporting insights. And then finally, we look at the impact of recent interest rate increases. And I think what's important here, we've all seen supply chain issues, we've seen inflation, we've seen interest rate increases, and all of this, it's like a little bit of a circle, and it's all impacting each other, and it's kind of growing in steam. And now that it has an impact on the measurement of assets and liabilities. So, for example, impairment of assets, absolutely, Kevin, your favorite standard and favorite area is a very important part of what we'll have to look at 31 December this year. Also, how do we determine the fair value of financial assets and liabilities and the related disclosures? Fair value of investment property, fair value of biological assets. If you look at leases, lease liabilities, determining lease liabilities, long service lease liabilities, defined benefit superannuation obligations, fair values of options that you've issued under IFRS 2. And then one that we talk about a lot at the moment is the appropriate measurement of provisions, including restoration provisions or make good provisions at the end of a lease or at the end of the life of a mine. So all of this, all the economic factors have an impact on the value of assets in the balance sheet, the value of liabilities in that balance sheet. And you can see it through fair value of assets and liabilities. You see it through provisions, and you see it through impairment testing. And so this will be a big focus, not just for 31 December, but I think for a number of years. So again, we've written an article which we've titled what the 6 recent interest rate increases mean for your 31 December financial statements, and we've explored that in greater detail. I think that is definitely another must-read article. So if you need assistance, we've got a number of IFRS and corporate reporting leaders across Australia. So Etienne and I are based in Melbourne, but we also look at our national offices. We've got Ashley in Perth, Clark in Brisbane, Lynn in Adelaide, and obviously Kevin in Sydney. And we've got a large team, and this team is ever growing. And I think the other thing you can see from this team, it's a team that's really heavy with partners, a lot of partners and a lot of directors. So it's a team full of senior people because the matters we're dealing with are quite complex, and you need to be an expert in these areas. Plus, please feel free to reach out to us and we can see if we can help you. So Kevin, I can't believe it, but we are finishing 4 minutes early. For once, they're not going to kick us out of our meeting rooms. So thank you very much for joining us today. We hope you found it useful. High-level flyover. If there's areas you have to explore more, please go and read those articles and reach out to us. Thank you very much. Take care, Kevin. Bye-bye.
Bye.